Hey there, it's Matt from CoinDepth. There's been a lot of buzz lately about new tax policies and proposed import tariffs, and while the news is focused on trade and inflation, I'm looking at something deeper. What do these moves mean for crypto? In this video, I'll walk you through how tariffs, rising costs, and changing tax dynamics could ripple through the market and what that means for Bitcoin and altcoins. Stick with me till the very end, because I'll reveal the real economic trigger that could silently launch the next crypto wave. Certain policymakers are proposing aggressive tariffs on imported goods, some as high as 60%. The goal is to encourage domestic production. But the side effect, higher prices for everyday goods, from electronics to food, that's where inflation creeps in. And when people feel their money buying less, it begins to shake confidence not just in the economy, but in the currency itself. Every time trade restrictions or tax policies shift dramatically, traditional markets get rattled. Tariffs often lead to increased import costs, slower global trade, rising inflation. And when inflation starts rising but wages don't follow, you get a tighter consumer economy, exactly the kind of environment that creates uncertainty. And investors hate uncertainty. Unlike fiat currencies, Bitcoin doesn't rely on tax systems or trade agreements. Its supply is fixed. Its rules are transparent. It's governed by code, not committees. During times of inflation or aggressive economic policy, people start turning to alternatives, especially if they believe their money is losing value. That's why crypto has earned a growing role as a hedge asset, especially in high-risk environments. While public focus is on taxes and inflation, smart money is tracking movement. Are stablecoins moving into exchanges? Is Bitcoin dominance climbing? Are whales accumulating while retail hesitates? These are early signs that institutional investors are positioning, not panicking. Here's what you stayed for. The real trigger isn't tariffs, it's interest rates. If tariffs drive prices up, the Federal Reserve may respond with tighter policy, higher rates, or slower monetary easing. That creates a double squeeze on the economy, less spending power, and more expensive debt. And when that happens, many investors start shifting toward assets that aren't controlled by central banks. My take: we're entering a phase where crypto will no longer react just to hype, it will move based on macro shifts. If new tariffs push inflation higher and rates react accordingly, we could see Bitcoin reassert itself, not as a moonshot, but as an economic counterweight. And personally, I'd rather be exposed early than left watching later. If you found this breakdown helpful, go ahead and hit like and subscribe. I decode global finance through the lens of crypto, right here every week. This is Matt from CoinDepth. Stay sharp, stay informed.